Ladies and gentlemen, good day and welcome to Q3 FY24 PDS Earnings Conference Call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Diwakar Pingle. Thank you and over to you, sir.
Thank you so much, Muskan. Good afternoon, good morning, everyone, depending on the geography of this town. I welcome you all to the PDS Limited's Q3 and 9-month FY24 earnings call. Today from management, we have with us Mr. Palak Seth, Executive Vice Chairman, Mr. Sanjay Jain, Group CEO, Mr. Rahul Rajah, the Group CFO, and Ms. Reena Joseph, the Head of Corporate Finance, M&A and Chief Investor Relations Officer. Please note that a copy of our disclosure is available on the investor section of our website as well as on the stock exchanges. Please do note that anything said on this call which reflects our outlook towards the future or which can be considered as a forward-looking statement must be viewed in conjunction with the rest of the company faces. This conference call is being recorded and the transcript along with audio of the same will be made available on the website of the company and the exchanges. Please do also note that the audio of the conference call is copyrighted material of PDS Limited and cannot be copied, rebroadcasted, attributed in press or media without specific and written consent of the company. With that said, I'd like to hand over the call to Sanjay Jain, Group CEO, for the opening remarks. Sanjay.
Thank you, Diwakar. Good morning, good afternoon and evening to everyone. A very warm welcome to our Q3 and 9 months FY24 earnings call. Before we dive into the quarterly and 9 months operating and financial performance, let's please take a few moments to discuss the current economic and industry landscape that has shaped our journey so far during the year and which we believe will also have an impact in the coming few quarters as well. As we step into 2024, the global economic conditions stand at a crossroads, blending challenges with rays of optimism. While the World Bank projects a modest growth, there are very promising signs of improvement on the horizon. The ongoing geopolitical challenges, along with the recent Red Sea crisis, is continuing to impact the global trade. However, there is definitely room for cautious optimism. One beacon of hope is the resilience demonstrated by the US economy, which has proven to be a stabilizing force amid the uncertainties around. Furthermore, the inflation rates are gradually aligning with the central bank's targets worldwide, instilling confidence in the economic stability. The potential for interest rate reductions adds an extra layer of positivity, offering the prospect of stimulating the economic activity. With these encouraging factors at play, there is a chance that in the coming months could exceed the expectations, bringing about a more optimistic economic outlook on a global scale. Overall, the industry will continue to see some demand headwinds, but our discussion with our clients is suggesting a revival in demand is definitely there in the coming few quarters. In some way, we believe while we also had first 2 quarters of a decline in sales, in Q3 we are flat, which means we're nearly bottoming out and we're heading for growth in the current quarter and hopefully thereafter as well. While the performance of this quarter has been below expectations, we are confident that this is merely a temporary phase. At PDS, we had to take a call that, should we wait for investing into a robust performance to follow in the coming few quarters or, should we kind of defer the investment? We made a decision to invest into people who are definitely enabling us making inroads into the US market and now also enabling us make inroads into the Indian market as well. The industry disruptions are presenting new opportunities for PDS to strategically partner with global brands and retailers. Our consistent efforts over the past 2 years are evident in our performance during these challenging times. The introduction of new service offering, namely sourcing as a service and tech-based design group, has effectively helped us mitigate the industry decline. We are pleased to report significant progress in both our sourcing as a service and agency businesses, with 9 months of GMV for these business models recording 260% and 90% growth respectively. In the sourcing as a service model, our GMV has surpassed $350 million for the first 9 months of FY24, which I just mentioned is a 260% growth over the same period last year, and the agency business clocking 118 million GMV in the first 9 months, a growth of about 90% over last year, reflecting robust performance in market demand. And therefore, this performance was giving us an assurance and confidence that we should continue to keep investing, into our efforts into US market and Indian market, and it's a matter of time that this will start giving us results. Unlike any normal company wherein the investments typically happen through balance sheet and then you reap the benefits until such time you get into commercial activity, it remains in your balance sheet. In PDS, it actually gets into the P&L. So therefore, when we are bringing senior resources, it's actually happened, in terms of Q3, wherein when you observe an employee cost increase, from our perspective, that is an investment that we are making for winning business into US and Indian market. But the cost increases now, but we feel that in about 4 to 6 quarters, one should see a significant impact of this investment coming back. Of course, in the immediate next quarter and thereafter, one should see growth coming back in design-led sourcing. But this investment that we chose to make in the third quarter is surely going to add to more benefits in the subsequent few quarters as well. Aligned with our strategic objective to expand in the US market, we are very pleased and excited to announce that Target, a leading retailer in the US, has been added on a platform as a new client. And we are very confident and positive that we just onboarded them this quarter. We'll be gradually nurturing this relationship. Like some of the US-based clients that we've added in the last few quarters is Walmart, JCPenney, and also Kohl's. In fact, to talk about Kohl's, for example, the relationship started with doing fashion business, and as the relationship is maturing, besides fashion, we're also getting into doing core line activity with our customers. So we believe this Target onboarding is a major win for us in the US market, and therefore should lead to scaling of the relationship in the coming few quarters. India also we have chosen to be a focus market for us. And as you know, India is about $100 billion retail market, fastest growing. But now India has prominent retailers who represent a size and scale wherein PDS is well poised to start positioning its service offering to them. And recently we solidified our presence in the Indian market by securing a sourcing as a service contract with Myntra. And this contract is actually to enable them start outsourcing, or sourcing garments from outside India as well. So therefore, PDS is now able to bring its experience of successfully practicing sourcing as a service for brands like Hanes, brands like, retail format like Asta. At the same time, having a global presence, for example, in Bangladesh and other countries, we're bringing these trends now to Indian retailers. And while I mentioned to you about a major win of Target onboarding in US, likewise there is a signed customer contract with Myntra for enabling them source from markets outside India as well. In fact, these developments underscore our commitment to expansion, innovation, and strategic partnerships. We remain focused on delivering value to our clients and leveraging growth opportunities in key markets to sustain our upward trajectory. Therefore, as demand rebounds back across various geographies, our existing businesses will recover. We believe this quarter we should see growth bouncing back, and we stand to benefit not only from the growth of our current ventures, but also from the disproportionate profitable growth of our new ventures. Our confidence in the aforesaid mentioned outlook is evident in the investment we have made in enhancing capabilities, recruiting talent, and somewhere, as I mentioned, this Q3 as compared to the previous Q2, we made a decision to invest into senior talent to enable us get business in India and US market. We also chose to invest into Sri Lanka, and we believe in the current market conditions, given the global footprint, given our strong financial position, there is an opportunity to get partner factories on board. PDS will continue to be asset light, but we spotted an opportunity to get about a 25% stake in a facility in Sri Lanka, and with an option with us that at the same very, very low valuation that we got, we can actually step up our stake to nearly half in due course of time. Notably, industry veterans such as Mark Green and Harold Tillman have recently joined PDS, bringing with them their extensive networks. We will leverage their connections to promote the narrative of customized solution that PDS can provide to global brand and retailers. We also recently acquired a new office in Watford, UK, which will house PDS operation close to key customers while showcasing our presence in UK. PDS actually has got now a PDS tower in Gurgaon, which is primarily catering to our design capabilities to support the global operations. It is supporting to our commercial activities for the global operations. While we are using few floors for our own consumption, few we are letting it out to reputed companies. So therefore, PDS tower in Gurgaon, we are running it as an independent P&L. We have an investment in real estate in our office infrastructure in Hong Kong, which is actually housing key of our businesses and global treasury activities. And now we believe this presence in UK, which is primarily house our Poetic Gem operations, and internally this Poetic Gem vertical, which is somewhere closer to $350 million in top line, has itself got a trajectory to be $1 billion in about 3 to 4 years. We believe this office infrastructure that we have invested into UK will reflect the need of the vertical to grow, and also the stature of the organization in terms of positioning its services to reputed clients. In conclusion, drawing from 25 years of experience in the industry, we have consistently observed disruptions that often serve as catalysts for new collaboration opportunities. Therefore, we strongly believe that the resilient business model we have cultivated has weathered these challenges times and position us for recovery. In fact, our history tells us that whenever there are tough times, PDS tend to gain manifold in terms of size and a foothold in terms of relationship with the customers. With that said, we now pass on the call to our Group CFO, Rahul Ahuja, who will provide an overview of the financial performance for the quarter.
Good day to all on this call, and thanks Sanjay for setting the context by outlining the macro challenges and opportunities in today's world. Now let's delve into the financial performance for the quarter and 9 months ended December 31st, 2023. In the first 9 months of this financial year, we reported a top line of 7,157 crores with a gross margin of 20.6%. Despite a 9% decline in top line, the value of gross merchandise we handled increased by 19% from 8,978 crores to 10,724 crores. This growth demonstrates our resilience and ability to thrive amidst market disruptions. Our gross margin improved from 16.8% last year to 20.6% in 9 months of FY24, driven by higher margin ventures like sourcing as a service and Ted Baker. Additionally, negotiations within our core design-led sourcing business contributed to expansion of the gross margin. The employee and other expenses costs have shown a year-over-year increase of 22 and 18% respectively. Like Sanjay mentioned, this has been largely on account of the new businesses we have added onto our platform, which is Ted Baker and Gary Weber. And these obviously didn't exist same time last year. Despite demand pressures in the core business, we have refrained from any drastic cost containment measures, as we believe the recovery is around the corner, and we should retain and we need to retain our talent and capabilities to capitalize on this opportunity. It's important to note that other income in 9 months of the previous financial year included a one-time gain on the sale of real estate, which affects the comparability of EBIT and PAT year over year. Interest costs also rose due to an increase in the average base rate, which is SOFR, from 2.62% to almost double at 5.23% this year. While taxation is higher, it's largely attributed to the Ted Baker operations, which have been profitable from day one, and those profits accrue in a high tax jurisdiction. Coming to the performance during the quarter, we clocked GMV of 3,868 crores versus 2,950 crores last year, translating into a growth of 31%. We arrested the decline we witnessed over the last 2 quarters of this fiscal. That is, in Q1, revenues declined by 10%, and in Q2, they declined by about 16%. In Q3, the reported top line of rupees 2,580 crores is flat as compared to the same period last year. Gross margins in Q3 FY24 increased by 333 basis points to 20.8%, echoing the trends observed in the 9 months. Similarly, increases in employees and other expenses are consistent with year-to-date figures. This translated into an EBIT of 67 crores versus 120 crores reported during the same period last year. During the quarter, the base interest rate, which is SOFR, increased from 3.82% last year to 5.32% in the current year, translating into higher interest cost. The increase in taxation, as I said, is largely linked to the Ted Baker business, which is in a high tax jurisdiction. Turning to our balance sheets, the net debt has increased from 27 crore rupees to 253 crore rupees year over year, whereas in the previous quarter, which is September, this debt was at 178 crore. This increase is mainly on account of the Ted Baker acquisition, which was financed through internal accruals and was partly replaced with an overdraft facility. We have now got a non-recourse factoring limit from our prime bank, which is DC, which would help reduce the debt further. Further, we also invested in the UK property, like Sanjay mentioned in his conversation. While working capital days increased to 9 days this year, excluding the Ted Baker component, our net working capital days stands at 2 days, aligning with our historical performance. The implementation of the non-recourse factoring lines that we have recently got sanctioned for is expected to reduce receivable days, particularly for Ted Baker. Despite these dynamics, our balance sheet continues to remain robust, with strong leverage ratios of net debt to EBITDA at about 0.61 and net debt to equity at 0.22. In conclusion, the resurgence of demand and the promising performance of our new ventures bolsters our confidence in achieving growth in the upcoming quarters and driving steady progress in quarters to come. With this, I request to open the floor to questions, and we will reply to those amongst us.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. And the first question is from the line of Akshay from Sam Capital. Please go ahead.
Hi, team. Thanks for the opportunity. Can you hear me?
Yes, please.
Just wanted to hear from the management because last quarter on the call, Mr. Jain sounded very confident that growth will pick up quite a lot in the second half of the year. So just wanted to know the details of what's happening at the customer end as most of the restocking over. Just wanted to delve into a little bit more details because Mr. Jain was really confident that we will end the year with, say, single to double-digit growth rates. Yeah, that's the first question.
Yeah, so allow us to answer this in 2 parts. while I will reflect on the discussion we had in the past, we also have the benefit of our Vice Chairman, Palak Seth, who's dialed in. So I'll be requesting him soon to share his perspective on interface with the customers. But yes, we did anticipate that the growth would be bouncing back in the second half of the year. And somewhere we are witnessing that traction. As I mentioned in my opening remarks, from a decline of sales of 14-15% in the first 6 months, it is flat now in the quarter 3, and we are confident that there would be a growth in quarter 4. So therefore, yes, there is a lag of growth returning back by a quarter or so, but we believe the growth is now there. Amidst cautions, I think I'll continue to be cautious, but this quarter we are witnessing growth traction. And let me request Palak, you want to add in terms of this piece.
Hi. Yeah. Good afternoon, everyone. So I think, the customers' inventory issues which were there post-COVID in the last year have more or less been taken care of. And this Christmas has been positive for most of the retailers we are working with. So we are definitely seeing the uptake on consumption in these markets we are operating, but more importantly, the customer base we are working with. So, there's been a lot of cleanup. A lot of the small, medium-sized retailers in the last 12, 18 months have gone out of business. So whichever retailers are remaining, which is predominantly the customer that PDS works with, is beginning to see growth as well. So combination of growth coming from consolidation industry, existing retailers we are working with, getting a higher share of the market, along with cleaner inventory, is I think definitely going to drive our growth coming through next year. And already in Q4, we are seeing that impact in our order books.
Okay,
Yeah.
Thanks for that. So my second question is more related to the American market. I mean, as you mentioned, you did quite a few hirings in that market. But still, I mean, despite being the biggest market, it only contributes about, say, 12% to our of our business. And also we had plans to acquire a factory in and around Egypt to service the American markets. I mean, also, do we have any acquisitions planned in the United States market, or we'll just hire from the ground up and build business from the ground up? Or is there any acquisition in the United States market in specific that is planned?
So next year's budget already we are seeing U.S. market share percent of turnover going up to almost 20%. Sanjay just mentioned, Target USA, which is the second or third biggest retailer in the U.S., which is hundreds of billions of dollars, was evaluating close to 150 vendors in the last 18 months to bring on board. I'm very proud to say out of the 150 vendors they have evaluated, only one was bought in, which was PDS. Right? So PDS being an asset-light business model, whereas all the other groups that were put forward were large asset-heavy businesses. The reason PDS was bought in because, Target US has this whole aim for moving to sustainability innovation, and they saw PDS as a perfect partner to provide them not only design development, FOB, LDP options, but also partnering with them in the journey of sustainability and innovation. So that account alone could be in hundreds of millions, because they don't add a vendor to do $1-2 million business. If they add a vendor, it has to be scaled. Similarly, Walmart, is also one of the largest retailers, as in the world, is strategically looking at PDS and various options. So we feel very confident that, the way we are positioned in the U.S. market right now, and there's restructuring happening in the U.S. market where there's a lot of cost cutting happening at the retailer's level, and the service provider is required to fulfill those requirements, because if retailer doesn't have that cost, they need someone else to take on the cost and service them. So combination of, adding these large U.S. accounts, which typically in 25 years we've been trying, we were not able to get. When the last 6 months we've had these wins, is definitely going to help drive our U.S. business. So our current approach is more organic because, there's a lot of good talent available. We will bring them on board and organically grow with them. It's cheaper that way for us because then we don't have to take on debt and, have, pressure on our balance sheet. But saying that, if you find some small, medium-sized companies which we can get a net asset value or, almost acqui-hire teams and plug and play them on the platform, we will continue consuming those as well. So just last week, I spent the time in the U.S. and had meetings with several large retailers. So PDS is the only company, which in the vendor base gets appointments straight at the C-suite level. We're meeting the CEOs of these large S&P 500 and Fortune 500 companies, which are strategically talking to PDS on various opportunities, No other vendor globally has this opportunity that we are getting to engage at the senior leadership level of these retailers, and not only talking about supplying products, but providing services that we offer as a company, either being a vendor with design or becoming a sourcing and service partner or help launch brands for them. So Sanjay had mentioned about Kohl's as well. So we are a vendor to Kohl's right now, but now our recent discussion with the management of Kohl's has been, can you guys take over one of their existing brands, which is a $40 million brand right now, to do end-to-end design development and, sourcing, which has a potential to become a $200 million brand in the next 3 to 5 years. So they want PDS to, hire a design team and do the whole brand from end to end. So they're very like that from the retailer side. So, I feel very confident, that the US business could probably, become 50% of our turnover at a very high base, with Europe and UK growing as well in the next 3 to 4 years. Yes,
thanks
please.
for that.
Hope I answered the
last question, if I may. So just, Palak, I just wanted your industry-wide view on the threat from a lot of the ultra-fast fashion guys, such as Shein and Temu, on some of our incumbent customers and our industry as a whole. Just wanted your view on that. Thanks for that.
Yeah, it's a very good question, very valid question also. Basically Shein, and just for information, Shein is very closely associated with PDS at this stage in terms of the senior leadership is talking to us about doing some brands business, and other things, because they see PDS as also a global partner for their needs, especially in the West, because they're a China-based company and they need to launch brands. So they're talking to us, can PDS help them and either develop brands or launch brands? So that just shows association, not PDS seeing them as a competitor or they seeing PDS as a competitor, but as, a potential collaborator for future opportunity. But I think, the business model they've developed is, very fascinating, because they're almost a zero inventory model. They're putting small quantities on websites, seeing the customer reaction, and then going to bulk production within 2 to 3 weeks. So Shein is definitely impacting other online retailers globally. We see in UK alone and Europe alone, companies like Boohoo, Misguided, ASOS, Zalando, which were the large online, pure play online retailers getting really impacted. We're also seeing companies which are in fast fashion, like New Look and few others, which were catering to the young customer segment, also getting impacted. But, PDS does not play in that segment. So our customer base are not these young fashion retailers or these pure play online retailers. So we are not directly seeing the impact of any reduction in demand where these retailers in the West are seeing. Our customer base are predominantly the large volume retailers, who also supply value, like the supermarkets in Europe or the large big box retailers in US, or also, these kind of specialty retailers like Primark. So at that level, we have not seen too much market share being taken by people like Shein and Temu. But there definitely is something to watch and, also to keep a careful eye on. Another point I want to mention, the Shein supply chain today in China is almost become a commodity. That means there are 10,000 factories in China which are now actually supplying Shein, but they have excess capacity to offer that to other retailers. So PDS China operations has also launched a product of ultra-fast fashion delivery to its customers, where we are able to create a software program which will plug into many of these. Out of 10,000 vendors, we feel around 500 or 800 vendors or factories are compliant to PDS standards. So that software platform, taking those 500 or 800 factories, we're still evaluating the final number that fulfills the compliance requirements, can be onboarded on PDS platform to provide the same sourcing that Shein gets for its direct-to-consumer business for PDS to offer to its retail partners as well. So we are piloting that with one Indian retailer to begin with, but also some of the European and US retailers, we started showcasing this as a product. So, yes, there is some disruption, but at least Shein reached out to PDS to collaborate. So that gives you just some perspective as well.
Thank you. The next question is from the line of Pritesh Chheda from Lucky Investment. Please go ahead.
Yeah, thank you for the opportunity. Sir, from your initial slides of the presentation where we have given the GMV, so is it fair to assume that these new models of software as a service and agency business is where there is this whole interplay between revenue and GMV? So had you not done, let's say, the SaaS or the same clientele, if you had not done the SaaS or the agency business, then the GMV would be a part of your revenue, being the let's say, design, sourcing on design or pure sourcing? That's how we should interpret this?
Yeah, I think if I understand your question rightly, we have reported for 9 months ended December 23, 10,724 crores of GMV. Yeah, and the revenue from sale of goods is about 6,829 crores, and there's other operating income of 327. So revenue is 7,517. And now, specifically in answer to your point, the agency sales have been 982 crores for the 9 months, and the source, which is we said is about 90% growth over the same period last year. The sourcing as a service, the sales are at 2,912, which is the GMV that we handled, a growth of 262%. So on the 981 of agency, on the sourcing as a service of 2,912, it is an average 4 to 5% that we get, if that gets booked into our revenue. So therefore, to answer your question, this is a difference of 38 crores in the GMV and in the revenue for the 9 months period.
Okay. And the same way when we look at the GP number, so you have a gross profit, so though your revenue decline of 9% is there, but your GP has grown in 9 months and GP has grown in the quarter 3. So now that's a function of the fact that the SaaS and the agency business has grown, which wouldn't have the revenue, but only would have the GP or the profitability element to it. Is that interpretation correct, sir?
I think yes, partly right. There is Ted Baker that got added, in the current quarter. Current was the full quarter of Ted Baker business, and that is, relatively speaking, a high gross margin business. That is one factor to gross margin enhancement. And yes, secondly, for me, both the sourcing as a service and agency business are much, much higher gross margin business. And whatever pretty much is the revenue actually gets pulled into gross margin. Yes, partly what you said is the reason, partly Ted Baker is the reason.
Okay. My second question is, sir, with respect to your, operating profitability, a lot of the GP has got consumed in, two heads, the other expenses and the employee. I heard your comments about your people increase in US and Indian market. But if you could just give a little bit more elaboration in terms of what kind of teams you have increased, because the increase as a percentage of sales in both these heads is fairly high. So we need to understand that part. And second, you were running your business earlier at about, let's say, 3, 4, or, between 3 and 4% EBITDA margin. And at that time, the cost of borrowing in the system was, less than 1% or, 1.5%. Whereas the margin is still the same, but the cost of borrowings have gone up. For the same business, the ROEs become different. So how should we now interpret your business considering the cost of finance? So these are two different questions.
Yeah. So I think on the first one, both Palak and I would, because besides giving the names, I want to make use of benefit of Palak being there in terms of the utility and the value these people are adding. But firstly, on the number bit, on the first part, I think if I have to attempt, for example, our, there is approximately between the quarter 2 of this financial year and the quarter 3 of this financial year, there is approximately about 60 to 70 crore element of cost increase that has happened, and nearly about 12 to 15 crore is in the other expenses, and the remaining 45 crore is in the employee costs. So that's the increase that has sequentially happened. And I think in the other expenses there is a bit of travel that has gone up because we are increasing our engagement with the customer, as you should see as a part of investment. That is what I mentioned. And other expenses are at 77 in Q2 versus 191 in Q3. I think somewhere a midpoint is a sustainable level as we go ahead. And I'm giving you answers more on Q2 versus Q3 because that is more like to like as compared to same period last year. Because same period last year, Ted Baker was not there. Same period last year, Gary Weber was not there. But Q2, Q3 are comparable. So therefore, in the other expenses, from a 176 to 191, somewhere closer to that is a sustainable level. Employee cost increase from Q2 to Q3 of about 45 crore. I would tend to break it up in three parts. There is an element of about 3-4 crores, which is the wage increase that nearly happened for a month in quarter three in both our factories in Green and Progress. And it takes a while for us to pass it on or engage with the customer. When you engage with the UK and European customers, which is predominantly the ones that are occupying the two factories, one see a decent possibility of passing it on. But a bit of lag. In the month of December, I had a 4 to 5 crore of element of that. Then there is an element of about 8 to 10 crores. Typically, whatever is the performance of last year, we make our best estimation wherever feasible, and we try and look for the incentives of people. But you always have some lag, in terms of what you accrued and what you actually pay. There's an element of about 10 crores of incentive in that, which is a one-time that happened, because of the high profitability. As I said, we make our best estimation to accrue. But then there is a large element of about 25 to 30 crore, which is pertaining to the new people that we have actually got on board. And that is where, before we go to the second question on finance cost, so this 25 to 30 crore that has happened because of the new people coming on board, I'm requesting Palak to chime in and give you an insight into who these people are and what are the potential benefits.
Yeah. So we've got few very senior industry veterans, have joined PDS recently. A gentleman called Mark Green. He was the director of sourcing for Walmart, for Victoria's Secret, and most recently for PBH. He's with Tommy Calvin Klein. So he's been in the industry 25 years. He just left PBH and he joined PDS to help, look at as a US strategy and, help expand and increase our network in the US. We have a new board member, a lady called Sandra Campos, again based in New York. She was the president of Centric Brands and for Global Brands Group and some other large US companies, and has extremely strong network in the US at the C-suite with all retailers. So we also benefit from her joining us. Another very strong industry veteran and guy called Krishanta. He was the CEO of Epic. Epic is one of the large manufacturing groups in Hong Kong doing $700 million. He was there for the last 4 years. Before that, he was in Walmart for the last 15 years. He's also joined our company to help expand our US business and network. So, PDS is finding opportunity with some of the most well-regarded, respected senior industry leaders who have multiple offer letters on their table from various companies globally, choosing PDS as the right company because of our culture, because of our products that we offer, because of the infrastructure and ecosystem we have created to come and join our business and, help expand our services to US retailers and customers. We also are planning, I think, Sanjay, on the board meeting, we discussed about bringing, one large American brand into India on terms of a wholesale basis, So we have another industry veteran who's a gentleman called Vedji, who's also joining us, to take that large US underwear brand opportunity on a wholesale basis into the Indian market. So we are very proud, PDS has become a platform not only for the best retailers and brands in the world, also for some of the banks, who want to reduce the exposure of small, medium-sized companies, wanting to give us additional limits as a platform company to, provide working capital financing to factories and customers, but also some of the leading talent in our industry globally wanting to join us and, offer services to the network being part of PDS platform.
So, sir, which means these costs are an ongoing cost, right?
But they're ongoing costs without any revenue. So, once these people join, each of them, they're talking about $1 billion revenue. Like Mark Green, who's, got a target that the US business of PDS should become $1 billion in the next 3 to 4 years. Obviously, they're building blocks towards that. So,
so the operating leverage will then flow in. Right now, you got hit by the operating deleverage because of the cost. That's how we have to interpret these costs, right? Yeah.
Exactly, yeah. Because, the talent gets available. This is once in a, kind of 10-year industry shift happening because there's a lot of restructuring happening at the US retailer level. So the top talent is getting available. There's a lot of cost cutting at the US retailers that they are doing. They require a company to provide services. I for example, was in New York, had a meeting with Tommy Hilfiger himself. The guy who basically is one of the most successful and, obviously well-known retailers globally. And his exact comments were, Palak, he has not seen a company like PDS in his career. He's one of the most formidable retailers around the world. He said the services and the kind of product offerings you are giving He's never seen it, and he sees there's a huge potential for PDS to do many things. And even he's like, let's talk, he gets these opportunities coming on a regular basis. He said PDS will be the first company he will get in touch to take care of those opportunities. So I think our US business has not happened last many years, but with the structural changes happening, with the investments of the quality of people we are making, it could overtake our European and UK market in like 3 to 4 years. Or 3 to 5 years. Yeah, we have to be cautious, but yes, the building blocks are there now finally.
ROE?
Sorry, just one point to add. I think pertaining to your previous question around the difference in GMV and our own revenue from design-led sourcing. I don't think we are cannibalizing our own business. When we, for example, Asta as a client, what we have been hitherto doing with them design-led sourcing, and which is continuing healthy. Of course, the market conditions have impact quarter to quarter, but the relationship is well intact. And it is a tech pack business. Tech pack means the customer is actually, giving designs to factories. And this is a tech pack business that actually typically we are taking over under a sourcing as a service contract, wherein we are supporting the retailer reduce their cost structures of running their own offices or having people on board in managing the factories. So tech pack, I am taking over gradually from retailers under my offering sourcing as a service. My design-led sourcing business is very much intact and is going to grow as well in line with the market. Just to clarify on that particular point. And I think on the finance cost, if I got, and I'll also request Rahul to chime in, our debt utilization levels typically haven't, gone up on an average basis as compared to the same period last year. It is the increase in the finance cost, the SOFR, the base rate, that has actually gone up. And in my opening remarks, I mentioned that one is probably also observing that the interest rate should witness a decline. So therefore, we should start benefiting in a quarter or two from the declining trends in the finance cost as well. Rahul, you want to add anything?
So I guess, Sanjay, you covered it absolutely right. The base rate has almost doubled from the same period last year to where we are today. And even if you were to see during the year, there's a difference of almost 170 to 180 basis points of increased the rate that we are witnessing. But as we do the journey during the next year, it's anybody's guess that sooner than later this trend should reverse in the global markets, and we will then stand to benefit from that as well.
Can I ask here my clarification?
Yes, please.
I understand the rate has gone up and the cost increased, but actually for the same business that you do and for a cost that increases because of the financing, the ROE comes down. So is there a way to mitigate this? For the same business, your profitability becomes lower, right? Your PAT margins becomes lower because finance cost goes up. So is there a way to mitigate all this?
Yeah, I think as Rahul was mentioning, that we wrote a check of about 150-160 crore business in terms of working capital that we got into a fold when we got TechBaker Design Group into a fold. That's the upfront investment we made. And now, few months into getting this into a fold, we have got a non-recourse factoring line, up and running soon in a month's time. But we got the line sanctioned from one of our leading banks. That would actually, reduce the capital that we deployed by half. And therefore, from our return on capital employed, which eventually translates to return on equity, we believe whatever we invested, the numerator has started to happen in terms of EBIT. The denominator, the capital employed, we clearly see now an opportunity in 30 to 60 days to try and squeeze it down by way of utilizing the non-recourse factoring facility.
Okay, sir. I'll take this offline. Thank you very much and all the best to you guys.
Thank you.
Thank you.
Ladies and gentlemen, in order to ensure that management is able to address questions from all participants in the conference, please limit your question to 2 questions per participant. Should you have a follow-up question, we request you to rejoin the queue. And the next question is from the line of Rishi Modi from Marcellus Investment. Please go ahead.
Yeah, hi, Sanjay. Can you hear me?
Yes, please. Yeah, Rishi. Hi.
Hi. So, Sanjay, just a couple of questions. Firstly, on the TechBaker piece, right? So if you could just give us the economics of how it's going in this quarter, how do you envision it going? How much is the GMV? How much revenue, gross profit? What are the costs sitting, fixed costs sitting in there? How much is our capital blocked out there? And how will this flow over the, say, next 1 year or so?
So, Rishi, as far as Ted Baker business is concerned, like we have said earlier as well, it's been profitable from day one. The business is largely has two components, which is the wholesale and agency piece, and it's been ramping up well since we got it on our platform around mid of June. We have, in the 9 months period ended December, done about 345 crores of top line in Ted Baker, with a bottom line PAT margin of about 7.1%. As far as the split of the business is concerned, it's largely between wholesale and agency. It's largely 50-50. In agency, we get a fee of 10% of the business that goes through us. So we feel that as the market rebounds, it should have a rebound effect on this business as well going forward, and it should perform consistently for us both as far as top line and bottom line is concerned.
Capital employed.
Yeah,
and capital employed is concerned, I think Sanjay mentioned that it's actually capital employed is kind of a misnomer, because basically what we did was pay for the working capital, which is inventory and receivables, which was around $18 million from our internal accruals. And as our factoring lines get into place, about half of that will be replaced, by the factoring lines. So effectively, the net capital employed in this business from our side, which is working capital, should be about $9 to $10 million.
Okay. And I recently read an article that the retail chain which operates the stores of Forever 21 in, I think, UK and Europe, right? They have gone under, or some issue has happened between ABG and that retailer. So just if you could give an understanding of what's happening out there. It's Forever 21 or Ted Baker, either of these guys, the retailer has gone into some trouble or some disagreement with the ABG group. So if you can just shed some color out there.
I think
so just a couple of points. Sanjay, sorry. I think this Ted Baker case study we should present to the investor community. In Ted Baker case study on how PDS, what was paid for the asset by the New York IP company, what PDS finally paid for it after without recourse factoring, and what is the bottom line we're expecting and return on capital employed we're expecting on this business. So as Rahul just mentioned, from 18 million are working because of the without recourse factoring, which could take some time to bring on board. Our net capital employed will be down to $8-9 million. And the profit of the business is close to like $6 million in year one. So, the $9 million capital employed between 5 to 6 million is finalizing a figure for the year is the profitability of this kind of business model. So it's a highly profitable business model that can be multiplied into various brand management opportunities around the world, because New York IP companies are continuing to acquire various brands, and we need operators like PDS to come and run them. Someone who pays so much money for a brand,
Hello, So I'm talking about issue between authentic brands and AARC.
So I'm coming to that. So I'm just first clarifying the business model and the multiple options that can come similar basis. So ARC was basically, when PDS got the opportunity, we basically, as a B2B business, decided that we're not going to get into retail, e-commerce or concessions. We will just take care of running the head office, against which we get a commission of anything these retail operators buy from the factories as a fixed commission of 10% on the FOB value, and we run the wholesale, which is predominantly pre-sold, so there's no inventory risk. So ABG broke this business down into various, maybe 10 global franchisees, the retail operators in India with Aditya Birla, in China there's someone, in US there's someone. So in UK, Europe, there's an operator called ARC. So ARC was unable to, get the financing in place to operate the retail stores and e-commerce and the concessions that they were supposed to. So ABG basically has replaced them and come in themselves as an operator of the business. So which is a good news for PDS, because, instead of having a counterparty like ARC, which is not a properly funded business, ABG has decided to run the business themselves for the time being. So they are now capitalizing the business further, putting in close to, I think, 18 million pounds into the retail operation to capitalize it correctly and then, make it more stable and invest in the brand to grow. So ABG is a $40 billion today retail IT brand owner. So for them, any brand acquired, the stability of the operation is key. They cannot have any issues in any of the operations. So ABG took the right decision that the counterparty in UK and Europe was not able to operate the stores correctly with, the financing required. So they replaced them and took over their equity and running it themselves. So we are in a more stable position now than we were before with ARC as a counterparty.
Okay, super. Second question I had was on the deal wins that we've done, Myntra, Target, and the Indian retailer whom we have tied up with. So how big an opportunity is each one of these?
See, they all take time, but I think Myntra probably for year one is around $15 million to begin with, as a baseline of the business. Obviously, it can double, triple in the next 2-3 years, depending on how the business goes. Target US, obviously is onboarded PDS as a vendor. So we are expecting by Q4 24-25, we will start shipping our first orders. We are in the process of onboarding some factories right now. But Target US, is not going to onboard a company to do $1, $2, $5, $10 million. They onboard a vendor to do $50, $100 million. So that can ramp up pretty quickly, So the discussions are happening, multiple engagements are happening with them at various levels. So as I said, out of 180 vendors that evaluate last 18 months, only one was added, which was PDS. So we feel, it could become one of our top 10 accounts in the next 2 to 3 years.
Right. And this Indian retailer that you all have tied up with, who is that and how big is an opportunity is that?
That is still under, discussion NDA. So once, it's finalized and signed, then we can please.
Thirdly, the Noblesware acquisition that we've done, right? What's the FY24 revenue run rate, EBITDA, PAT? FY23, I can understand, it looks cheap on FY23, but things are not the same since last year. So just trying to get a hold of how things are moved out there.
Well, Sanjay can tell the figures. We just mentioned from my perspective, Noblesware is being seen as a top maybe 5-7 manufacturer in Sri Lanka right now with a very good customer base and a very high reputation. So the halo impact on Sri Lanka operation by taking a strategic stake in a company like Noblesware is already added more accounts to our design-led sourcing business. For example, Sainsbury's, a big UK retailer supermarket, was not currently engaging with PDS. After that acquisition, they've now onboarded us as a vendor, seeing the opportunity of PDS also having some, strategic manufacturing assets. Similarly, Primark, which is obviously one of the largest volume retailers in the world, is under discussion with PDS to basically become the exclusive vendor out of Sri Lanka with a potential volume of $100 million in the next 2 to 3 years. So, all these building blocks we do as a company, taking small strategic stakes in, businesses at a very low value compared to even book value, has a very big halo impact on our overall operation. So coming to the specifics of Noblesware, Sanjay can please mention now. Sanjay? Hello.
It was on mute from my end. Yeah. I think, but Palak, you were also touching upon that the ROI for us from such an investment is not just into the factory wherein we are acquiring a stake, also the rub-off effect.
Yeah.
So, but to answer specifically, we believe current year's profitability of the factory would be under pressure. I think it did an EBITDA of about 15 crore in FY23 and about 11 crore PAT in FY23. And from the current quarter onwards, if I have to paint a picture of next 4 quarters, we believe we should be running the factory almost at the same level. In the last 3 quarters have been a bit troublesome because of the factories running at low capacity because of the global conditions. But we are positive that from current quarter onward to next 4, we should be running the factory at the same level at which we acquired the profitability of.
Okay, superb. Finally, just to clarify, you said 30 crores you all have spent in bringing in, I think 3 people. One Mark Green, second Sandra Campos, and one other guy from Hong Kong. So these guys are getting paid like $4 million USD per year, or how is the working out there? Like this $4 million USD sounds a bit huge for an annual compensation.
Yeah, I think there is an element of joining bonus or an onboarding bonus which get expensed off. And then what we have shared with you are the people who are the leaders. They typically bring their own team of 2-3 people, or we give them 2-3 people, so therefore 30 crore is not just the impact of these 2 people, but it's a team that one has taken on board.
Okay, got it. All right, fine, super. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Varun Gajaria from Omkara Capital. Please go ahead.
Hi, sir. Thank you for taking my question. So I just had a question on the Ted Baker and on Jerry Weber, the integration. Now it's been seen that in this quarter our costs went up substantially because of the integration of these businesses. So how are the costs expected to look in the coming quarters? Like, are we done with full integration? How is it faring, and how will the margins look now?
I think as Rahul gave you an insight into overall Ted Baker financial, and he also mentioned that we expect the traction to continue. In quarter 3 that we reported, I think it will be fair to say that both the Jerry Weber getting into a fold and Ted Baker, the cost structures have now actually been captured into the P&L. So it is now normalized in terms of Q3, Q4 onwards. We don't anticipate any incremental costs getting added up. For example, if I have to speak, the Jerry Weber, revenue is like 9 months is close to about $22 million. It was zero. But now on a quarterly run rate, to stay close to the question you asked, the cost are fully factored. We should see the benefits now flowing in on top of it.
Okay. That's it from my end. Thank you. All the best.
Thank you. The next question is from the line of Chirag from Ratnatraya Capital. Please go ahead.
Hi, good evening. Thank you for the opportunity, Sanjay and Palak. Just one clarification question. The new members who have been brought out, the senior members, they have basically been brought onto our rolls. Is that how we understand it? Or is there a different sort of a commercial understanding there?
So, one of them is on a board, wherein the payment is through a sitting fee, of they playing a role on the listed company board as well as the subsidiary boards. For example, the new board member is also on the board of the US subsidiary to support the US business. So that's on the board part. But beyond that, the others are actually, in the capacity of employees or consultants. Mostly employees that have, in lieu of employment, they are on board.
Got it. Understood. Just, couple of clarification questions. One on the factoring side, is it probably correct to understand that once the factoring comes in, that would have a commensurate impact on the gross margins? Your realization should go down a little bit there, given that you would get that money earlier and get it factored. Is that right, or am I missing something there?
In fact, it's an interesting point. There are 2 facets to actually, the factoring cost is actually gets into my finance cost. So to that extent, it does not impact the gross margin negatively at all. And when I said 2 facets, in fact, there's a potential upside to gross margin because I am able to get factoring money, much sooner, and then I am able to sit across the table with my vendors and pitching for early payment discounts. And to the extent that I am actually able to get EPDs, which are actually much higher than my financing cost, that EPD I get a benefit in the cost of goods sold. It gets adjusted from there. So therefore, increased factoring gives me a leverage to actually negotiate better and therefore improve my gross margins.
Understood. So if I just summarize that, essentially the gross debt would go down, finance cost also would come down by a little bit, not by a large amount, but you'll also get maybe some benefit on the gross profit. Is that the 3 effects of the factoring?
Correct. The finance cost may partially go up because when I'm availing the non-recourse factoring, then I'm actually raising money which has a cost. So therefore finance cost would go up. The capital employed would come down, the debt would come down, And now that I have more money into my account, my flexibility to sit across the table and get an EPD goes up. So gross margin accretive, yes. Capital employed reduction, yes. Finance cost goes up because I'm availing more factoring.
Finance cost in comparison to the base quarter right now, where instead of factoring, we were actually drawing down an overdraft. So in that comparison...
Correct. So you're right. If you compare it with the overdraft getting replaced by factoring, then the impact is not there on the finance cost. However, if you were to compare it with an internal accruals funded deal getting replaced by factoring, then my interest cost will go up.
Incentives that you pointed out that we might have sort of proportioned a smaller amount. Is the right understanding then this 10 crores should have been around 2.5 crores each quarter for the last 3-4 quarters? That's what should have been, instead of the 10 crores this quarter, maybe 7.5 crores should have come in the last 3 quarters. Is that the way we should get that?
Yeah, you can at least say that, that one could have, as I said, we try and use the best efforts to factor it in. But to the extent there is any gap and it gets paid off, it got paid off as a one lump sum in this quarter, and therefore it actually should typically get amortized over the entire year.
Understood. Thank you so much. Last question. The Jerry Weber business, can you elaborate a little bit more about how should we look at that business? Does that fall into wholesale, agency, services? Can you just talk a little bit more about that business and going forward, how that would look like? Thanks.
Oh, there is one like a design-led sourcing wherein I take my design, get the orders, then sourcing of the services. I get the designs, and I'm actually running an office on behalf of the retailer and charging my fee for handling volume for them. And now there is a third category, which is the Jerry Weber business's complete sourcing solution. The retailer is saying, I've got nothing to do with designing or sourcing anything. You please 100% take it over. And that's how we actually got this contract from Jerry Weber in Germany. And we, of course, when we have taken this contract from a credit assessment perspective, we've done our, management of risk by way of an escrow account with the customer of keeping some deposit, which reflects typically the inventory that we may have in transit or on our books before it gets passed on to the customer. We've also kept a right with us that I can use this inventory for others as well. So we've mitigated our risk when we have ventured into doing completely outsourcing for retailers.
Just one clarification. How would this be different from normal brand management that we would do, say, in other scenarios like Ted Baker? What would be the difference between this contract and a brand management contract?
As Rahul was answering that 50% of revenue stream of Ted Baker is, for example, the agency business, wherein while there are agents appointed or franchisee appointed by Ted Baker, ABG for Ted Baker business, for example, a name that resonates to everybody in India is Aditya Birla Fashion, who's running Forever 21, and Ted Baker as a franchisee. So now to answer the question, Ted Baker Group is actually is facilitating the designs for the garment that they are getting sold in the stores. Ted Baker Group that PDS is running is also facilitating the management of the factories. The factories are billing directly to the retailers here. So for performing the service of designing, for performing the service of managing the factories or managing the traffic, I'm actually getting a 10% agency fee. So that's the difference. So I am not buying and selling inventory. It is being directly billed. I'm just getting paid for my service. That's the difference between part of the Ted Baker business, which is the agency business, versus a complete sourcing solution. On the Ted Baker other bit, the wholesaling, wherein I am actually buying goods on my books and I'm selling it, while there is on the face of an inventory risk, but again in line with PDS philosophy, it's a pre-sold kind of situation. It is a wholesale business. It is not a B2C business. I'm not running retail stores here. I actually take it to the leading retailers who actually allocate space for Ted Baker brands to be laid out. And then typically we tend to engage into pre-sold orders so that I know that there is a visibility. And that is where I'm getting into an inventory that I'm buying on my books and then selling it to the retailer.
Thank you. Ladies and gentlemen, due to the time constraint, we will take this as the last question. As that was the last question, I would now like to hand the conference over to Mr. Sanjay Jain for closing comments.
Thank you, EY team, for supporting us on the logistics of the call. Thank you so much, ladies and gentlemen, for joining into our investor call, and we look forward to once again engage with you at the end of quarter 4 earnings call. And have a good afternoon and evening, all of you, and stay safe. Thank you.
Thank you. On behalf of PDS Limited, that concludes this conference. Thank you for joining us.